Do you see this as a turning point for the market, which has had such a stellar run-up from those March lows?
It got a little bit ahead of itself, but I still think the trend is up. I think this is what we'd call normal profit taking after a really huge run-up. I mean, I think the run-up on Friday's employment report was a little excessive. I wasn't as excited about it as several others. But the liquidity that's provided by the Fed and Powell, continues to say, we're not even thinking about raising rates. That's still going to feed this market. I look at monetary aggregates such as M1, not just the balance sheet of the Fed. It is up by over 25% in 8 weeks, which is much more than the whole year that followed the financial crisis of the Lehman Brothers bankruptcy. We're just putting so much liquidity in, and I think that once this economy opens up, as it is opening up next year, it's going to be pushing right into the economy and sending stock prices higher.
There is this school of thinking that the Fed did not sort of deliver on what investors wanted in terms of the economic projections, did not follow through on the optimism, even though investors seemingly also want the Fed to stay in stimulus mode. The bank's getting hit particularly hard this morning, Professor Siegel. So you don't see any reason to fear the Fed at this point?
Well, I think by saying that the Fed, that he's going to keep, I don't believe he will be able to keep that short rate as low as they say all the way in the next 2 or 3 years, because I think there's going to be inflation next year. And in 2022, the long rate's going to go up. And, when the long rate goes up, and I don't think he's going to get into trying to control that long rate, I think then you're going to start seeing that short-term rate goes up. But why the banks are down? Because, the yields are back down on the long term, and that margin is really important for banks. So, I mean, I'm not surprised that banks sold off today because, 10 years back at 70 basis points. But I think we saw the low in March on the 10-year, and I think that's going to be a 4-decade-year low. And we're going to start seeing that rate rise. And we saw it on Friday, but I think we're going to start seeing that rate continue to go up. That actually is going to be certainly good for the banks going forward to have a little bit of that interest rate margin. So this is temporary, I think, in terms of the market.
So would you tell investors to go out and buy some of those riskier pockets of the market that have been so sensitive to COVID-19 and consumer behavior changes? The airlines, which had a strong run-up and are getting slammed today, the cruise lines, the hotel companies. I mean, these are all right in the eye of the storm.
They are right, and they've come back. I think they overran a little bit because, we're not going to get that unemployment down to 3.5% for a while because there's going to be permanently unemployed people. I also think there's going to be a jump in productivity of a lot of firms because they're going to see that they don't need all the people that they had hired, but these people are going to have to find alternative jobs. All that thing is going on. But I think what's important is with my look at yields, I think the Fed keeping short-term rates low, long-term rates rising, which means it's dangerous to be in long-term bonds. Where are you going to get yield? It's going to be, I think, dividend-paying stocks. I know they have underperformed the last 5 or 6 years, 10 years really. But right now, in a moderately inflationary world, they're going to be the source of income in 2021, 22. So, my feeling is that's where you're going to get yield. Don't try to stretch too much in the high yield market. Certainly stay away from long-term treasuries because I think they're the most dangerous part of the market right now.